Everyone wants to buy at the perfect time, low price, big return, even the perfect entry. But the truth is, most people lose money trying to time the market, not because the market is hard, but because their behavior is. Timing the market fails more from behavior than knowledge. Today, we're breaking down the difference between timing the market and time in the market. It sounds simple, but this one decision changes everything because it will either build your wealth quietly over time or keep you stuck waiting, second guessing, and missing opportunities. Most people think investing is about getting in at the perfect time, but real wealth isn't built on perfect timing. It's built on consistent participation. Your strategy matters more than your timing. Timing the market, it sounds logical, but it feels like the smart move. You're trying to be strategic, but what it actually means is you're trying to predict it. When prices will drop, when prices will rise, when to buy, when to sell. The goal is simple. You buy low, you sell high. Why it sounds smart? If you could time it perfectly, returns would be higher. You avoid losses, maximize gains. But here's the problem. You have to be right twice. When you buy and when you sell, not once, but twice. And both decisions have to be correct. The reality, most people, they buy too late after the price already went up, or they sell too early out of fear, or wait too long and they miss opportunities. Because timing isn't about knowledge, it's about behavior under pressure. And most people aren't. Not consistently, and inconsistently, and time leading to inconsistent results. It's like trying to catch a wave at the perfect moment. Too early, nothing happens. Too late, you miss it. And most people miss timing. You have to be on time. Timing requires perfection. Investing rewards consistently. Why people try to time the market? Timing the market isn't just a strategy. It's psychological. People don't try to time the market because it works. They try because how it feels. What drives it? Fear of losing money. Nobody wants to invest and see their money drop, so they wait for the perfect moment to feel safe. Then you have the desire for quick gains. People want fast results. It don't work like that. Buying at the bottom and selling at the top sounds like the shortcut. Then you have overconfidence. After watching a few trends or making one decision, people start believing they can predict the market consistently. Watching news and trends, headlines, they create urgency. Market crash coming, the best time to buy now. This constant noise makes people feel like they need to act or wait for the perfect time. People want certainty in an uncertain system. That's the real issue. The market doesn't offer certainty, but people try to create it anyway. So they wait and miss. Opportunities don't wait for perfect conditions, and hesitation often causes more than mistakes. It's like waiting for traffic to completely disappear before driving. You might feel safer, but you never move forward. Waiting for certainty often leads to missed opportunities. What time in the market means. Time in the market is the opposite of guessing. It's not about catching perfect moments. It's about showing up consistently. What it means is investing consistently, putting money in regularly, not waiting for the perfect time. Then you want to stay invested, not jumping in and out based on emotions or headlines. And then you want to allow compounding work, giving money time to grow on top of yourself. You're not trying to outsmart the market, you're participating in it. And over time, participation beats prediction. All this works together because the market moves up and down in the short term, but over long periods, the trend upwards. Consistency allows you to benefit from that trend. You have to go with the trend. You don't need perfect timing, you need consistency because consistency captures growth. Timing tries to chase it. It's like planting seeds. You don't dig up every week to check progress. You plant them, you water them, and you let let time do the work. Time grows money. Timing chases it. Why time wins? Market moves in cycles. Short term, they go up and down. Some days feel great. Some days feel uncertain, but that's normal. But zoom out. Over time, markets historically trended upwards, not in a straight line, but in a long-term direction. And time is what allows you to benefit from that direction. What time gives you is more compounding. Your money earns returns, and those returns earn more returns. More recovery dips, market drops happen. Time allows you to recover and move forward. And then the market grows. It goes up with a trend, not just once. Short-term thinking, focus on volatility. Long-term thinking, focus on growth. Time shifts your perspective from reacting to participating. Time reduces risk. Emotions increase it. Because the longer you stay invested, the less short-term noise matters. But emotional decisions, buying and selling based on fear or excitement, increases your mistakes. It's like flying through turbulence. Short term, it feels unstable. But zoom out, the plane is still moving towards the destination. Time smooths the journey. Emotion disrupts that. The cause of waiting. Waiting feels safe. It feels responsible. It feels like you're avoiding the risk. But in investing, waiting has a cost. What waiting actually costs you? One, you have missed opportunities. While you're waiting for the perfect time, the market continues to move. Growth doesn't pause for hesitation. Then you lose compound timing. Time is the most powerful force in investing. Every year you delay is a year your money isn't growing for itself. You cannot get that back. Then you got number 3, you got delayed growth. The longer you wait to start, the longer it takes you to reach your goals. Starting later means working harder for the same results. All of this matters because waiting feels like protection, but in reality, it often creates missed potential. The biggest risk isn't investing, it's waiting too long. Every year you wait, you lose leverage. It's like delaying planting a tree. The later you plant it, the less time it has to grow. Time investing beats time waiting. You don't need to predict the market. You need a strategy you can repeat consistently. Just so have a simple approach. Invest consistently, put money on a schedule weekly, bi-weekly, monthly. Ignore short-term noise. You got news, headlines, daily swings. They don't determine long-term results. Stay focused long-term, think in years, not days. Then you have dollar cost averaging. This simply means you invest the same amount of money regularly, regardless of whether prices are up or down. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this balances your entry price. It removes the pressure to time it perfectly. Why this works, you stop guessing, you start building, and consistency allows compounding to do its job. Consistency beats prediction because prediction requires being right. Consistency just requires showing up. It's like going to the gym. You don't wait for the perfect day to work out. You go consistently and results follow. So, stick to the plan, not the headline. At iSHARE, we don't try to outguess the market. We don't chase perfect entries or predict every move because that approach depends on being right all the time, and that's not realistic. What we focus on instead is discipline, showing up consistently regardless of emotions. Then structure, systems that guide decisions, not feelings. Then we have long-term systems, strategies that work over time, not in just moments. This approach isn't flashy, but it's reliable. It removes guesswork and builds confidence. Because wealth is built through patience, not perfection. All of this works because perfection is unpredictable. Patience is repeatable, and repeatable actions is what create results. It's like growing a tree. You don't rush it. You nurture it consistently and let time do the work. Patience and structure build what prediction could never do. You don't need to be early. You don't need to be perfect, because investing isn't about catching the exact moment. It's about showing up and staying consistent over time. Most people lose not because they choose the wrong investment, but because they stopped too soon, waited too long, or they let emotions take over. The ones who win, they stay in, they stay patient, they stay consistent. You don't need to be early. You don't need to be perfect. You just need to stay in the game. Wealth isn't built by perfect timing. It's built by lasting participation. If this helped you, subscribe to iSHARE. This channel is about discipline, financial literacy, and building legacy. No shortcuts.